Good afternoon, Jags. This is Fahad. Today is Friday, May 29th. I have Chronicle here with me with an idea that he would like to discuss. Hi, Chronicle. How are you doing?
Afternoon, Fahad. I'm all right.
Good, good. Hey, going into the weekend, so just enjoy some good time after this. It was a shortened week, but it was pretty active for trading. So let's get started. Bank of Ozarks, or also known as Bank OZK. This is a bearish trade. You're bearish on the stock. Give me the biggest highlights. What's in your mind?
Sure. So first, a short introduction. Bank OZK was formerly known as Bank of the Ozarks. They rebranded themselves when they decided to expand out of the hillbilly regions and into Florida and New York. As it stands today, the majority of their presence office-wise is in Georgia and Florida. But really, the main driver of growth for the bank has been in New York City, which is now the Metro's third largest lender.
And
Um,
uh,
yeah,
Texas is also a pretty big piece of the total pie, right?
presence-wise, but loan book-wise, it's mostly concentrated in New York City and Florida.
Got it.
So on the next slide, here we have a rough overview of their loan book. We can see the bank is mostly focused on lending for multifamily real estate, commercial real estate, and construction. They have a self-styled RESG segment, which stands for Real Estate Specialties Group, and this segment oversees all of that. So RESG represents roughly 70% of all loans, with 43.4% exposure to Miami and New York City. And of note, hotels comprise of 15% of total loans, while offices represent another 15%. I know on this chart on the right it says hotels are 10%, but that's a bit misleading because if we look at the fine print in the 10K, there are some hotel properties that fall under the mixed use category.
These are very large exposures to struggling parts of the economy, the hotels and the office buildings. And it is yet to be determined exactly in months from now and quarters from now what the future will look like for a lot of these commercial real estates. Very interesting. That's a very high exposure, 70% of all loans, right?
hmm And if we look at the next slide, one argument of the bulls is that in terms of risk management, I would say that what sets Bank OZK apart from most other banks is its high level of conservatism. First of all, Bank OZK tends to have the lowest risk position in the capital stack due to its steadfast rule of being the sole secured senior lender. Like the bank always insists on having the first lien on the property securing its loan, and so they require developers to put significant amounts of their own equity up front. So on average, the bank only covers 49% of a project's costs. Secondly, the bank does adhere to high credit standards in its vetting process and is typically only interested in strong sponsorship marquee projects and low leverage and the like. So, considering we've been in a low interest rate environment where lenders are tempted to chase volume, Bank OZK's caution and thoroughness is pretty unique. But on the next slide, however, while being prudent sounds great on paper, the stock has been in a relentless downtrend since the beginning of 2018 for several reasons. Firstly, what's best for the bank may not be what's best for shareholders, because contrary to management logic, the market actually dislikes Bank OZK's refusal to ease up on its strict credit standards. Because from a market perspective, the bank is seen to be deliberately passing up opportunities for growth. Whether it's right or wrong, the market likes to reward risk taking rather than prudence. Second of all, the bank made over a dozen acquisitions from 2010 to 2017, taking on a significant amount of non-purchase loan prepayments in the process. This creates artificial pressure on the loan book, which has been exacerbated by the implementation of CECL. Thirdly, if you're familiar with the stock, You may recall that shares crashed 27% overnight in 2018 due to a shock announcement regarding loan losses that had been on the books since 2009. So while we're currently still seeing some remnants of sentiment being spooked by that incident, because there might be more skeletons waiting to be found in that regard. And last of all, this is from a macro standpoint. Despite enjoying rising loan volumes, loan yields and net interest income for Bank OZK have been deteriorating around the same time the Federal Reserve made its U-turn and bond markets were pricing in a series of rate cuts, as shown by the two charts below.
The net interest income chart has been in a steady decline for 6 consecutive quarters, and I'm looking at their last earnings report, and the company reported EPS in the first quarter of only 9 cents, materially below consensus view of 60 cents, and it was down 90% year over year.
Yes, that's
Uh,
correct.
and then
And
the revenues were down 5%. And then for the full year 2020, company cut guidance, which now implies a 50% decline in earnings and on 2% decline in revenues. But then after that, it appears that for 2021, they're expecting a hockey stick recovery with a sharp rise in earnings per share. And same thing with revenues. You don't believe that's going to happen in 2021?
yeah, going forward, I think those estimates still have room to downside. And the fact that shares have rallied 35% since April, while consensus has not revised its forecast higher, means there's a short opportunity developing here. Specifically, I see three major headwinds going forward. On the next slide, for the first headwind, we can see from the table on the left that total allowances of loan losses for the banking industry as a whole has only just begun to accelerate and still remains a fraction of what it used to be in 2010, despite conditions being much worse now than before. Granted, we do have idiosyncrasy today like low interest rates and loose monetary policy, but that doesn't mean banks shouldn't up their contingencies when we're seeing statistics like 45% of April retail rent still not being paid as of May 22nd, according to CoStar Group. At least half of the labor force working from home while offices remain empty, and employers keep pushing back their projected return dates. Plus, we also have 25 million in continuing jobless claims. Turning our attentions to Bank OZK, according to the latest earnings, they have set aside 118 million, which represents only 0.65% of total loans, which is pretty low when compared to the industry average of 1.77%. So the implication here is that if provisioning 118 million has already resulted in earnings contraction of 90%, what happens if they set aside more? Those in the bullish camp might argue that they can get away with such a low provision due to conservatism in lending, which I just outlined. But if we look at the latest Federal Reserve stress test results, the report found that under the worst case scenario, which is 10% unemployment, curve steepening, and asset deflation, basically what we have today, banks would only have set aside 37% of what would be needed. This means if we trust their 0.65% provision, Bank OZK's loan losses could still potentially reach 3.5%.
That's a very big disconnect there, and I was going to ping you on this one. So, just to recap the most important highlight there, currently they have only 0.65% of total loans in reserved on the books. The industry average is 1.77%. And your math shows that the loan loss reserves could be as high as 3%. So the delta between 0.65% and where your estimate is of 3% is very, very wide. I mean, if we think about this, when the stock crashed in October 2018 on a $46 million loan loss reserve, that was only, by my math, 20 basis points of a shock in the loan loss reserve that caused the stock to crash by 27%. And here we're talking potentially 230 basis points of underreporting or under recording of those credit loss reserves. I mean, if even marginally, even a small percent, a small fraction of that actually gets recorded and comes to light, there could be more shocks in the stock going forward, as investors are simply not accounting for it. Especially considering all of this in light of huge exposure the company has. You've mentioned 15% to hotels and 15% to office buildings and other stuff. So very interesting stuff there.
Yeah, I've also seen bullish sell side arguments pointing to the bank's low LTV ratio, but I would argue that in trying to play it safe, management has unintentionally put the bank in a lose-lose situation because if they adhere to their risk management model, I would imagine very few loan applications this year will meet their high standards. And moving on to headwind number two, I think private commercial real estate in large metros will likely slow to bounce back. Firstly, if we look at the latest regional architecture billings indices on the left, we can see that the scores for Northeast and South, so where the bank derives its revenues from, are in deep contraction and lagging the West. Meanwhile, the sub-indexes of inquiries and contracts have come in below 30 for 2 months running now. In
Yeah,
terms of
for
leading,
just want to point out to the audience here, for those who do not know, the Architectural Billing Index or ABI, below 50 reading, below 50 is what considers pretty bad. I mean, basically, that's where the contraction begins. And here we are looking at these numbers on the left side of your chart here, Northeast, Midwest. I mean, these are just disaster numbers. So if it continues or stays in this way, then on the right hand side, I'm assuming those vacancy rates are just going to continue to go up, aren't they?
yep. So I think we'll continue to see many white collar employees work from home now that all of the infrastructure has been set up. It's almost a guarantee that not every job that has been converted into telework will return to the office, whether it's out of convenience or need to cut costs. Um, I think this could lead to a potential trade-off where an increasing number of people willingly choose to work from home and avoid having to commute in exchange for slightly less pay, which is an avenue we know Facebook is currently exploring. And currently, COVID-19 has resulted in 62% of Americans working remotely, and we're already seeing news of various large companies looking to shed workspace or extend their work from home period. Like we've already seen Uber seeking to offload 65,000 square feet of office space. Morgan Stanley CEO said that the bank would need much less real estate in the future, with 90% of its employees working from home during the pandemic. Meanwhile, MasterCard will not ask staff to return to offices until a vaccine is available, and 90% of the workforce is already operating remotely. And I do list several more examples of this in the research piece.
This is interesting because I mean, I'm just trying to picture in my mind what does New York City, LA, and a lot of these other major metropolitan areas with clutter of office buildings and everything everywhere. What does the future really look like going forward from here, and how high the vacancies rate could go in this current recession? Headwind number three.
So the last headwind here is that a high amount of loans that Bank OZK acquired in the past from M&A is due to be repaid. This is going to result in a reduction of the loan book while the COVID-19 environment makes it difficult to generate new loans. Like if we were to look at this table right here, note that payoffs had already been growing for the loan book going into 2020. And now management is guiding for RESG loan repayments in 2020 to exceed the record level in 2019, and that the level of repayments may have an outsized impact in one or more quarters. And meanwhile, management unfortunately chose to begin CECL implementation on January 1st, which was bad timing with COVID-19 just around the corner. With CECL, Bank OZK will have to provide for unfunded commitments as well as life of loan estimates just incurred losses that had existed in 2019 and prior. The CFO has been coy about the earnings impact of the provisions, but he did let slip that it has indirectly resulted in not only provisions being higher than initially expected, but also the bank being even more careful about pricing and LTVs than in the past. So what this indirectly means is that the bank is likely to become even more prudent in its lending standards due to CECL, which is likely to result in less loans going forward. Like I know CECL on its own is maybe not a good enough reason to justify downside, but when we lay this out together with all the other headwinds, I think it does affect sentiment.
Yeah, this is interesting stuff. We don't really usually talk about whether we're looking at a lot of the bank balances and high amounts of loans, how the loan book actually also shrinks with this kind of headwind that's in play. This is very interesting stuff. So now looking at technically, the stock has bounced back recently. In fact, it's bounced back, what, 35% off the March lows. But you believe that this bounce up to the resistance is precisely where it's presenting a new shorting opportunity, and you're looking for pretty significant downtrend to begin from these levels.
Yeah, the strategy here for me would be to wait for the current rally to reach resistance around $25. I think it almost touched that yesterday, and then we would initiate a short from there. And you can see I've annotated basically a summary of how we've gotten to where we are now with regards to the historical price chart.
Where would you put your stop at this if we initiate a short around 25?
Above VOP resistance, I'd say around 28.50.
Okay. And then your long-term target, let's say over the course of next 12 months, you're looking for this to return to mid-teens or even low teens.
Yeah, low teens.
Interesting. Good stuff. So, this is pretty clever research here, pretty well thought out and detailed research over here, particularly about the loan loss calculation. We have done similar kind of work on some other regional banks as well, particularly those, for example, that are exposed to the energy cycle, where I've noticed some very low reserves on the books when they should be materially higher. Your case in this one is more focused on the commercial real estate and the exposure to New York City and other major metropolitan areas. Uh, Great stuff, Chronicle. Thank you very much for this idea, and thank you everybody for joining. And we'll see you next time.